Hi, thank you everybody for joining in. So today the topic is NIO, and NIO is one of our PMSs in the entire iThought PMS suite. It is meant only for NRI investors, and that's why today I think the audience also is majorly from Southeast Asian countries, Singapore, Hong Kong. But this is a product that we thought when we initially ideated that we need a particular product for NRIs, it suits NRIs. We were wondering why is it that we need a product itself for NRIs, and we understood that they have goals in India. They want to retire in India. They want to save money in India, and this is one of the best ways that they can do, which can give them more than their NREFDs are, right? Whatever they can save here in India, right? So that was the reason of why we thought that yes, we should cater or come up with a product that can serve the needs of the NRI as well as help them achieve their financial goals in India. Right? So what is it that NRI? What is it that NIO can do for NRIs? Right. So this is NIO. It's just a small summary. Right. We look at the landscape, then we look at the strategy, how the strategy is sort of working, how the investment philosophy has been built all this while. And NIO is also it's not a model, it's a tried and tested method. It was born out of the RIA service that we were doing. So it has a good 13-year track record. And we'll show you how NIO sort of manages a multi-asset investment strategy. And then we look at how we have currently invested and some examples here and there. Right. So NIO is a multi-asset, it's a dynamic multi-asset PMS, right? The strategy that we have here is that we can go 0 to 100 in any particular asset class, right? We can go 0 to 100 in equity, we can go 0 to 100 in debt, we can go 0 to 100 in precious metals. We also have the option to take up exposure in foreign equities from India, and we can go 0 to 100 in cash, right? And we can do this by having, it can be directly in equity, it can be directly via stocks, or it can be directly via ETFs. Again, in debt, it's a mix of ETFs, precious metals again is via ETFs. So everything is a good mix of having a direct exposure, as well as within that sort of direct exposure, we can take up different asset categories like direct stocks or straight via ETFs. Right. So NIO does not have any borders. Right. We can go 0 to 100 anywhere. Right. In equity, and this is why we wanted a more flexible sort of mandate. Just like Sphere, where our other multi-asset strategy that also has a very flexible mandate. We wanted a flexible mandate for investors outside India because we understand that opportunity comes up in all places. Right, winners keep on changing and losers keep on changing. Right. So we wanted a flexible mandate where we can go 0 to 100 in any particular asset class. Right. And even in that particular asset class, we can take advantage of any asset, any particular category that can give us that opportunity. Like say, for example, it's there in the later stages of the slide. But for example, if we want to take an exposure in a particular theme or a particular sector, right, we take that call to understand, is it better for us to take a basket approach, or is it better for us to take a single stock exposure, right, a single business sort of an exposure, right? And then we take a call as to, okay, if a basket is more is sort of better for us, then we take the basket, right? So it has no borders. This is why it works for us, right? It's a very flexible mandate. It gives us the option to do a lot of things on NIO, right? So what is it that we follow? We follow a thematic style of investing, right? We like to take exposure towards high conviction themes that contribute towards GDP growth, right? For example, infrastructure and financial services are a big part of NIO right now, and that is more thematic in nature. So we have been building portfolios that are thematic in nature, that do have high conviction towards themes that contribute towards GDP growth. Right. We only like to invest in industry leaders. So we back market leaders who operate in favorable industry structures, but we are very conservative and disciplined in terms of valuation. Right. We don't like to overpay for any particular business or any particular basket. That's why we have this bias towards investing or backing companies that are leaders in their respective industry. So it might be 1, 2, or 3. They might be within the top 3. They might be within the top 4. But we have that bias to go towards larger players who are industry leaders, right? While we take a thematic exposure, obviously we have a long tail where we can take that exposure towards smaller and mid companies, but our bias is more towards larger companies because they lead the pack. They've been in the industry for long. They've been able to weather through all conditions that have been put forth to them, and that's why we have chosen this sort of a philosophy where we want to go only towards, right now it's more towards larger companies, right? We can have this entire shift towards other asset classes. It's a lateral shift between asset classes across market cycles, right? It doesn't mean buying and selling. It just means we are incrementally trying to add more and more money into various asset classes. Let's say, for example, right now on Indian debt is very attractive, right? Today we are having Indian debt yield somewhere around 7.3%, right? And we are getting included in the global bond indices. So that means that we are having we will have about 20-25 billion out of inflows that come in the year, and that is very favorable for Indian debt. Right? It makes sure that the Indian debt market is a lot more deeper now. Right? Indian debt market right now is only driven by government flows, and a majority of the participants only participate in government papers, right, and government tenure papers, right. So it opens up the debt market. It makes it a lot more easier for us to participate in debt as an entire idea, right? So we are able to invest across asset classes, and that not only helps us grow but helps us preserve, right? Some market cycles are such that we might not be able to take advantage of equity as an asset class, right? In those cycles, we are able to take advantage of precious metals and debt as an asset class, right? So it helps us laterally shift across asset classes because we don't have any borders, because the mandate says so, right? This is our investment philosophy, right? And naturally, consistent compounding is something that we aim for. We are conservative in terms of how we are building portfolios, but we are very aggressive in terms of position size, right? We because we are coming in with high conviction, we like to buy more of it, right? Just to put it in easy terms, we like to buy more of it, right? So our entire philosophy is to create, preserve, and sustain. Hey, we don't want to be too aggressive when it comes to valuations, and that's why our entire endeavor is to grow very moderately, and this works for investors who have a lower risk profile, at the same time who have this goal of retirement in India, right? This suits those investors who have a moderate low risk profile, at the same time have this goal that they want to retire in India, right? Now, NIO's investment framework is very simple, no cap on any particular asset class. We follow a top-down and a bottom-up research on all asset classes. So I'll show you an example of how we are doing top-down and bottom-up. And we are concentrated across themes, which is more sectoral, thematic in nature, with a market leadership bias. So only industry leaders is what we're looking at, right? Now, this is a very important slide, right? This is how we are unlocking prosperity, right? There was one slide that said there was one part in the slide that of the investment philosophy that has consistent compounding, nurturing each asset class, right? This is how we are trying to nurture each asset class, right? So you look at a top down and a bottom up sort of approach. So you look at top down. Today we were in a scenario where inflation was very high, interest rates were very high, which means that it gives us opportunities to take advantage on the fixed income side. Right. Now we take another scenario, high growth and earnings re-rating, which means there is good amount of growth coming in, right? And earnings are getting re-rated, which means the bottom, that is the earnings are growing very fast, which means that equity gives us the option to participate more on the equity side when equity outperforms, right? Then a scenario comes where there is low growth, right? And you have to employ a dynamic sort of a strategy, right? At that point, multi-asset starts outperforming. Right, and today we are in such an economic environment right now. It gives us that option right now to take advantage of dynamic asset allocation. Right now in India, dynamic asset allocation is all that people need to be looking for. Right? So it's grow smart, grow strong. It's wealth for every tomorrow. Right? This is how we are trying to build only versatile portfolios because we want to prosper in all markets. Right? All markets gives us that opportunity to sort of participate in different ideas and in ideas in different asset classes that help us prosper in all markets. Right? Versatility is what we're trying to add into your entire investment framework. Right. So this is how this is just a very nice example of how we are trying to look at top down and bottom up ideas. Now, this is the NIO think tank, right? How do we maximize yields when looking at top down or bottom up opportunity, right? Now, let's say there's a thematic idea. Let's say we are trying to do more on the financial services side, right? Then we look at, okay, do we need to take it from a broader perspective or do we need to go business wise? Now, let's say, for example, we are taking a more top down approach, right? Now, in the top down approach, there are two strategies. One is active, one is passive, which means one, when you are looking at active, we are going more towards direct stocks, right? We are going more towards, let's say in the case of debt, it will be high quality debt, right? And it will be precious metals, right? This is more of an active strategy. If you look at a passive strategy, there we're looking at a basket. There we're only looking at ETFs. It's more sectoral, global, and debt, right? Now, for example, we have taken a more equity-oriented a sector or a theme. So we've chosen a top down, and within the top down, we've identified that because the entire pact is extremely cheap, the valuations are extremely cheap. Credit growth in India is getting stronger, and net NPAs are also very low. Right? So we want to take a more broader based approach. So we go with the passive strategy. While we go with the passive strategy, the only option that is available to us on the passive side right now is more on the ETF side. So we are able to take more options. We are able to take more exposure on sectoral ETFs. Right. So this is the NIO Thinktank. This is how we are able to maximize yields on each of the ideas that we want to start of investment. Now, let's say there's a bottom-up idea. Let's say within the financial services pack, right? We want to take only one particular idea. Let's say in terms of insurance companies, right? There is no passive strategy that allows us to take exposure directly purely into insurance companies, right? So there we have to be more active when it comes to allocating money. There we have to be a lot more picky when we are allocating capital. Right. There we are able to take a direct exposure within any of the insurance companies that we are very bullish on, where the metrics are extremely good. Right. Where again valuations are somewhere on the cheaper side. That's where we are able to take an exposure. Right. So this is what NIO does. This is how we are able to unlock prosperity. Like I said, in every scenario, in every market, we are able to build wealth, and we are able to grow that wealth because of this particular think tank. Right, because we are able to take advantage of top-down and bottom-up opportunities. So it's in a way it works very, very well for investors. Now let's give you an example of how we have taken this advantage of top-down and then going towards passive and then choosing a sectoral ETF. Now this is public sector banks. Now public sector banks as a pack was extremely cheap. They were more cheaper than private banks in the entire financial services. But the entire banking pack. Financial services within financial services, public sector banks also were extremely cheap, right? So wherever we were looking at public sector banks having the largest deposit base in India, they were extremely cheap, right? Though in terms of ROAs and ROEs, they were slightly improving. It was not very bad because they were at a cyclical bottom. It would look that it is extremely low. Right, but when the cycle turns, naturally that number starts going up, right? So everything was fitting the bill for us, and we had to choose whether we want to go via active or a passive strategy. Now, because the basket fully was cheap for us, we were able to take up a passive call, and within that passive call, we got a sectoral ETF where we could take advantage of this particular idea, right? And this was not a small percentage; it was quite a large. It was one of the top 3 positions that we were having in NIO. So we were able to buy for 1.5 years. So whenever we are taking exposure in a particular business, it takes us a long time for us to continuously keep buying, right? It would take us a year and a half. Sometimes it would take us 2 years also when we are trying to build conviction and act on that conviction in that particular idea, right? And then we were able to reap benefits out of it. So even if you check today on the public sector bank side, today again, a while back they were trading at all-time highs. But this is how we are trying to build portfolios in NIO. We take time, right? Every portfolio in NIO is built completely different. It's based on opportunity on when you come on. Let's say, for example, if you do come on today, portfolios that are being built today are drastically different from the ones that were built since inception, right? So right now, this is not an idea also that is going in, but since it's not there in the portfolio anymore, we have the liberty to share it to you. Right. But every portfolio that we are building is completely different. It's based on your need, is based on your risk profile, right? And only then, and that think tank is how we are able to employ for each and every portfolio, since it works according to your own goals, right? So every portfolio is being built different, right? Portfolios that are coming in now will be completely different from those that we built 2 years back. Okay. If you look at it, even on the debt side, you see there are many ideas that we were able to play. And right now also we are looking to have some exposure on the debt side. We've not tried to add a lot of debt because we are again in the think tank, right? When we are looking at top down and we're looking at active and passive, we are only trying to explore more on the passive side, right? Not a direct exposure. So we're still exploring somewhere on the passive side, right? So always when it comes to NIO, you will get a fair idea of if it's a top down, what are we trying to do? If it's a bottom up, what are we trying to do? Right. So even on the debt side in the past, we have been able to take high exposure, high conviction exposure towards debt. Like for example, during the INFS crisis. So in India, there was a crisis where a AAA company had defaulted, and that was a very bad scenario that took place. It was quite an important day for even the debt markets because AAA yields after that shot up to 9.5% in India. And we were able to take advantage of the creamiest layer of debt by having a 9.5 sort of yield coming in on AAA. Right? So even on debt, we are trying to employ the same strategy of being contrarian and being value oriented. By being value oriented in terms of what we are getting out of investing in these papers, and third being contrarian. Naturally, if the risk is completely low, definitely we will have that sort of exposure even on the debt side, right? So since inception, how has NIO actually performed? So when we benchmark internally, we are benchmarking us to a multi-asset mutual fund outside and a flexi cap, so a 100% equity fund also. Since we don't have any particular cap, we thought that yes, having a multi-asset sort of comparison to mutual funds work for us, right? So if you compare us to a multi-asset mutual fund out there on a 1 month, on a 6 month, and on a 1 year basis, we have been able to outperform, right? So if you take a flexi cap, which is 100% equity, which is what NIO can go to, right? 100% equity, right? And we do it across market caps on the equity side. So comparison towards flexi cap funds in the last 1 month, 6 months, we've been able to outperform since inception as well. But when you look at us, NIO is a strategy that was formed as a PMS only in 2022, in October 2022. So when you want to judge us only after 5 to 7 years. That this is a product that works for somebody who has a 5 to 7 year sort of horizon. Okay? This is not a product that you should look at for at least the first 2 years, because it takes us 1.5 years just to build that sort of an act on conviction that we're trying to build. Right? It takes us about 1 year, 1.5 years. In some cases, it has taken more than 2 years also for us to build on that particular conviction, right? So for the first 2 years, please don't judge us, right? But as mandatory, we do benchmark internally to multi-asset mutual funds as well as flexi cap funds, right? Because it's a 100% equity mandate. Plus, at the same time, the other side is yes, they have other asset classes that they can also take advantage of based on their mandate. Right. So NIO, 6 months since inception, we've been able to outperform everybody. The last 1 year, flexi cap funds in India, flexi cap funds have done extremely well. Your small and mid caps have been on a tear for the last 1 year. A lot of money has been being pumped on in small and mid caps. But overall, at the end of the 5th year and the 7th year, we are very confident that yes, we will be able to outperform them by a good margin. Right. So how does NIO actually handle drawdowns? So drawdown is the worst particular, let's say on that particular day, we've had the worst sort of exposure. So this is from the high of NIO. What is the worst drawdown that we've had? So for NIO, we've had a 4% drawdown, which means from its high, we've fallen about 4%, and multi-asset funds have been 5%, and Nifty has been 10% since our inception, right? Which means that we are able to take lesser risk at the same time deliver more. Right, we are able to take much more lesser risk than a multi-asset fund, than the entire Nifty 50. At the same time, perform better. Right, so risk-adjusted returns are far higher than just a pure Nifty ETF or a multi-asset fund. Right, but the risk would eventually go higher, because as we have, since it's flexible, since it's dynamic, we will have a lot more. Right, we will have within equity itself, we will have a lot more. Right, but our eye is definitely on risk-adjusted returns. Right. So in terms of what NIO is right now, in terms of risk-adjusted returns, we are doing extremely well. Right. So the fund is positioned, very simply put, it's an all-weather investing style, where we are only looking towards market leaders, and we are looking at a current theme. The current theme right now is the Indian financialization story. Right. Today, if you look at per capita income, we are somewhere in the $2,400, $2,500. That is expected to go and cross $3,000, right, in India in the next 5-6 years. Right, and that is a massive story here for India. That again is going to lead us, and it's going to lead in a lot more penetration towards financial services, right, as well as Indian consumption. So we are very well positioned in terms of what we want to take advantage of for the next 10 years in India. And the next 10 years in India, we definitely are advocates of the financialization story. As income grows, you will have more. Our insurance penetration is low. Our mutual fund AUM to GDP is low. So naturally, people will look for more avenues to start saving their money. They will get smarter as investors. So we are very big advocates on the financialization story of India, and we are only looking to go towards market leaders, right? All weather, naturally, because if you remember this slide, this is exactly all weather, right? In any sort of scenario, we are able to take advantage of all these particular asset classes, right? Because we don't have a particular mandate. It's all free. Right. So we are able to take advantage of fixed income, precious metals, and equity. Right. That is what all weather sort of means. Right. Where are we positioned? Like I said, this is for somebody who has a low to moderate risk profile and has a horizon of more than 5 years, of somewhere around 5 to 7 years, with a goal to retire. Right. Or any other goal also, if you have where you want to just build wealth in India and use it where you're currently living, that is also correct. Okay, but this is meant for investors who have a low to moderate risk profile, right? And your NIO return expectation should be in India average inflation plus 5 to 7%, right? So that's what we are sort of operating in. So it's much more than your is your FDs that you can park in India. At the same time, we are growing much more than inflation plus GDP growth in India naturally. Right, so this is how we are positioned, and this is how you should look at NIO when you're looking to build wealth in India. Right, the NIO promise: create, preserve, and sustain. We only our emphasis in this entire slide go on to sustain, because in any market, whatever you do, it becomes easy for you to create. Then preserving becomes a difficult task for you because you cannot commit to particular other asset classes because of your bias in equity. NIO does not have that. Right, as we create wealth, we definitely want to it's a seamless shift across asset classes, right? Because we can invest very diversely, right? Preserve and then come sustain, right? It's a very good cycle of when we look at building wealth in India and how we are trying to invest in India, right? We are able to take advantage of that precious metals, and we don't have a particular cap. Let's say for a multi-asset mutual fund outside, there are mandates, right, where they need to have 20 or 30% odd in debt, or let's say 10 and 15% in precious metals. They cannot go beyond that. They need to have a set allocation that goes into each of these particular asset classes, where we don't have. We can go 0 to 100, right? So even in the worst case scenario, we will be able to take advantage of debt wherever there is opportunity for us to take advantage of any of these asset classes. That's how we are able to sustain. That's how we are able to adopt strategies that can protect you against volatilities and economic uncertainties, right? That's how we are able to sustain wealth creation. Right. NIO performance since inception, we are at 28%. But like I said, don't look at us from a performance perspective right now. Anybody who knows iThought knows that yes, you need to look at what we are doing for the first 2 years, and only then judge us based on performance when the fifth year comes in. But what I want you to see right now is equity as an asset class, and on an overall basis for the fund is 80%. Precious metals is somewhere around 12. Cash is 2. Global is again 3.5%. And debt, which is very small, which is still very nascent, is just 3%. Right. So this is how NIO is currently positioned right now. This is from a fund perspective. But investors who come in right now will not have much exposure that goes into equity. That's the beauty of NIO, right? We don't have performance pressure. We don't have that pressure to perform right away, where we have a model portfolio. No, we take time to build positions. And right now, portfolios that are being built, they are equity exposure is just half of it, and the rest is in precious metals, global, and cash. Right, cash or cash equivalents is what you can look at. Right, so every portfolio is being built very differently based on opportunities that are there currently presented to us. Minimum investment is, as per SEBI mandate, for a PMS, it's 50 lakhs. The benchmark is multi-asset index fund, because it's a multi-asset strategy. Definitely it has to be the benchmark has to be more towards multi-asset, and what we've chosen is equity, arbitrage, and REITs. We do have that option to invest in REITs and invest, but right now we have not taken that option. Right? It's a fixed fee product. It's just 1.5% per annum compound on a daily average portfolio value. Right, but it is charged to you quarterly. Right, and GST would be some small bps. Right, this is for investors who have a moderate risk, low to moderate risk profile, with an expectation of 5 to 7 years. No cap. We can do 0 to 100 on equity, precious metals, global again, and debt. Right. Our single stock exposure won't go to 25% of the total NAV of the portfolio. That is very standard. But the minimum investment is 50 lakhs and INR, and we have a fixed fee, so there's no exit load. Also, you can exit whenever you want to. So it's a fixed fee of 1.5% per annum. Right. This is the team. We have a very dynamic team. So we are at least a 17 or 16 house team in terms of strategy and research. We have Gaurav, who is the investor relations. We have Ganesh, who is the product manager for the iThought PMS. But if you look at the team, Shamsa is the CIO, and he is the fund manager for NIO. And this is a product where the strategy team is currently working on this particular product. So there's me, there's Samyukta, there's Roshan, along with the head of investment strategy, which is Niranjan Sri. Right. So we have a very dynamic team. We have a dynamic and a young team. If you look at Balaji sir, he is also the head of research. He is the co-fund manager of TrueBlue, along with Sham sir, and Rohit and Rajat, who are managing the small cap fund. So TrueBlue is a large cap fund. Solitaire, that is completely managed by Sham sir, is a flexi cap fund, and Riddhi is our small cap fund. Right. So we are across all categories: flexi cap, large cap, small cap, and multi-asset. Right. Sphere is another multi-asset strategy that is for Indians in India, and NIO is the same multi-asset investment strategy for NRIs outside India. This is just a small brief of Sham sir, who is the fund manager. He has 3 decades of investing experience, and he follows a thematic-based approach. So his learnings and what we have learned from the entire RI service is something that is coming on to NIO and coming on to Sphere. Right. He follows a value and a content-oriented strategy. Likewise, here we don't do what the market is doing. At the same time, we are very conscious of what we want to pay for that particular business or for that basket of business. Right. So now I think I'll open the floor for Q&A, and we have a good amount of time. We have a good 20 minutes or so until we close, and I'll open the floor for Q&A. So you can put in your questions in the chat box. So there's a question of how is NIO different from a flexi cap fund, and how does it stand out of your PMS in solitaire? With the present performance, NIO is better than than your FD. Yes, NIO is better than the FD. NIO is different because we don't have, so flexi caps have a mandate to do only equity, right? And there they have a mandate, again, they will not have much debt. They will not have any precious metal exposure, no debt exposure, nothing. Right. So they are a 100% equity product. Right. And from our experience in investing in the Indian market, opportunities are there everywhere. Right. I did not put that slide across. Maybe next time I can put that slide where in every given year there is a different market winner, there is a different market loser. Right. So if you see collectively for 5 years, equity might do well, or for 6 years, then debt might do well, or for 5 years, debt might do well, and then equity might do well. Right. So flexi cap funds, they might not be able to take advantage of other asset classes. Right? We can take advantage of other asset classes, and they have a mandate. They have to go say 80 to 90% in equity, or 70 to 85% on the equity side as a mandate. So compulsorily they have to go out and invest. We don't have to go out and invest compulsorily, right? Because we don't have that particular mandate, right? Now, when it comes to solitaire, again, solitaire is operates on a moderate to aggressive side, right? That again follows a flexi cap mandate. So they don't take leverage companies, right? So we are allowed to take slight leverage when it comes to, because some industry leaders might have some leverage on their balance sheet. So solitaire is extremely strict when it comes to risk management, and it's a complement. So we always look at not that which one is better. We always look at whether it is a good basket, whether it is a good complement, right? So for somebody having a solitaire where it's majorly an equity exposure, right? We always try to complement something like a solitaire to a multi-asset sort of a strategy, right? So we are only looking towards complementing. We are not looking at a comparison, right? FlexiCap fund PMS works in a different manner. Multi-asset works in a different manner. There again, it's equity, and within equity, they play on different strengths, right? Here, the strength is completely different. It's more towards multi-asset, right? But when you're looking at the product sorts in I thought, always look at it from a complement perspective and not from a comparison perspective. Say this one is better or that one is better. Interest is tax-free. Returns can be expected in the range of 15 to 20% post-tax. See, for NIO, our expectation is average inflation plus 5 or 7%, and that is what we want to continuously compound at for a very long period of time. 5 to 7 years is what any investor sort of expects, because there is this norm of looking towards mutual funds, and all the communication that goes around mutual fund is that your long term is 5 to 7%, but long term is actually considered to be 10% plus. Right. So you don't look at you look at this strategy from about 10 plus years, but 5 to 7 is for somebody who has that goal for 5 to 7. We say 5 to 7%. But NIO definitely is a good alternative to your NREFD. Right. Your NREFD right now, if it's giving you a better opportunity, please stick to that. There's no pressure that you have to do NIO for that matter. Right. But if you're looking towards long-term corpus building in India, please do consider NIO. Right now, the AUM in NIO is somewhere around 58 crores. For this strategy alone, it's 58 crores. 58 crore INR. The other multi-asset, the Indian multi-asset strategy, that has crossed 400 crores. Thank you, sir. We will definitely give you marketing content. We will definitely keep you on our list and make sure that you're getting good enough data from our side as well. Thank you so much for joining in, sir. So I'll keep the floor open for another couple of minutes, and for anybody who has who have queries about how we're managing money in NIO, please do put it in the chat box, and I'll do my best to address it. Okay, so I don't think there are any further questions that we are getting. So now I think I'll close, but I'll put in our so I put in our number. So do get in touch with us with whatever queries that you have, and we'll be very happy to address it. Somebody from our team will get in touch with you, and you'll be able to get your queries all addressed. So thank you all for joining in. Have a great weekend. Thank you so much.